Every investor dreams of finding that one stock they can buy and forget for the next 10 or 20 years. But the problem is, most businesses don't stay winners forever. That's why finding a great business isn't enough. The real challenge is finding businesses that can keep reinventing themselves even after they have become successful. That's where long-term wealth is created. So we did the homework and we went looking for businesses that aren't just growing today, but are building the foundations to keep growing for years to come. Welcome to Evergreen Stocks Part 2. Yes, there was a Part 1 as well, and you can watch the video from clicking here and you can find it in the description too. Now today we are looking at 6 companies that are still finding new ways to grow despite already being leaders in their industries. For each one, we'll answer 5 simple questions. What does the business actually do? What's changing inside the business? Where is the next phase of growth coming from? What's the biggest risk? And finally, is this still a business worth owning for the long term? So let's get right into it. Let's start with a company almost every investor knows. Stock number 1, Adani Ports. Now, if I ask you what Adani Ports does, most people would probably say it's India's largest port company. And that's true, but I don't think that's the right way to look at the business anymore. Because Adani Ports is no longer just operating ports, it's building an entire logistics ecosystem around them. Think about how a container reaches your city. First it arrives at a port, then it moves to a warehouse, from there it travels by rail or truck, and finally it reaches a factory, a business, or even your neighborhood. Adani wants to be present at almost every step of that journey. That's what makes this business interesting. And the scale is already massive. Today the company operates 19 ports across India and overseas. It has 12 logistics parks, over 3 million square feet of warehousing, more than 25,000 trucks, 247 marine vessels and 132 rail rakes. Together, this network reaches almost 95% of India's hinterland and handles roughly 27% of the country's cargo traffic. In simple words, 1 out of every 4 tons of cargo in India touches an Adani Ports asset. And the business is still growing. Between FY21 and 26, cargo volumes grew at a 15% CAGR, faster than the overall Indian port industry. In FY26 alone, cargo volumes reached 501 million metric tons. Revenue grew 25% to 38,736 crore, while profits increased 16% to 12,782 crore. But during our research, I found this one point, and that's what gave me confidence. Management isn't adding capacity everywhere just for the sake of growth. They are expanding where demand is already visible. Take the Viz port. It reached full utilization much earlier than expected, so the company immediately started phase 2 expansion. The same strategy is playing out at multiple ports where capacity is being added because cargo demand is already there. And the long-term goal is ambitious too. The company wants to increase its domestic port capacity to 1 billion metric tons by 2030. But management has also been very clear. The focus isn't just on moving more cargo, it's on handling higher margin cargo, improving utilization, and using technology to make operations more efficient. But of course, no business is without risks, so here we go. Adani Ports is expanding aggressively both in India and internationally. Any delay in integrating new assets, taking on too much debt, or changes in regulations could affect cash flows and returns. Now let's look at the valuation. With a market cap of nearly 4 lakh crore and a PE of around 30, the market is already expecting strong execution, which means the company has to keep delivering. Now let's move on to our second company, Laurus Labs. For years, it was the HIV drugs company, but today Laurus is becoming very different. And that's exactly why investors have started looking at it differently. The biggest change is happening in its CDMO business. CDMO simply means manufacturing medicines for other global pharmaceutical companies. Think of it as becoming the manufacturing partner behind some of the world's largest drug companies. And that's usually a much better business. Long-term contracts, better margins, and stronger customer relationships. Today, Laurus has more than 125 active CDMO projects, and this business already contributes 31% of its revenue. Management believes that number could reach nearly 50% by FY30. And the company is investing heavily to make it happen. In FY26 alone, Laurus invested 1,000 crore, largely to expand its CDMO manufacturing capacity. And over the next 3 years, it plans to invest another 3,000 crore across areas like peptides, fermentation, animal health, and advanced therapies, including gene therapy and cell therapy. It's also building a new facility in Visakhapatnam with an investment of over $600 million, which management believes can become another major growth engine. And these investments are already showing up in the numbers. In FY26, revenue grew 23% to around 6,800 crore, EBITDA jumped 64%, and profit more than doubled to 889 crore. But here's the number that stood out to me. Revenue grew 23%, EBITDA grew almost 3 times faster. That's usually a sign that the business mix is improving and the newer segments are starting to contribute more. Now, no transformation stories without risks. CDMO is a project-based business. A customer can delay a product launch, a regulatory approval can take longer than expected, or commercial production can shift by a quarter or two. So don't be surprised if the company's quarterly numbers remain a little volatile from time to time. That's simply how this business works. Now let's look at valuation. Laurus now has a market cap of around 96,000 crore and trades at nearly 88 times earnings. So the market is already expecting this transformation to succeed. Now let's move on to the third company on our list. Imagine a business that doesn't manufacture cars, medicines, or electronics. It simply manages other people's money. And the more people invest, the bigger the business becomes. That's Nippon Life India Asset Management. Today, it is India's largest non-bank sponsored asset management company. But here's the number that really caught our attention. It recently became the first mutual fund house in India to cross 4 crore investor folios. No other fund house has reached that milestone yet. Now, you might think that's just because the mutual fund industry is growing, but that's only part of the story. Nippon is growing because it's reaching investors that many others are still trying to reach. Today, it manages around 8.62 lakh crore of assets through a distribution network of more than 1.25 lakh distributors. And here's where it gets interesting. A large part of its recent growth is coming from smaller cities, what the industry calls B30 locations. Assets from these cities have crossed 1.56 lakh crore, making up around 21% of Nippon's total assets, higher than the industry average. Even more impressive, 2.22 crore folios now come from these markets alone. And this is important because India's mutual fund story is no longer limited to Mumbai, Delhi, or Bangalore. More people from smaller towns are starting to invest. And if that trend continues for the next decade, companies like Nippon could continue benefiting from it. That's the real long-term opportunity. And the financials reflect that momentum. In FY26, the company reported 2,708 crore in revenue. Profit grew 19% to nearly 1,500 crore. But yes, there are risks. For an asset management company, one of the biggest risks is simple. If markets fall sharply or investors start withdrawing money, the assets it manages can decline. And since its earnings are linked to those assets, profits can also come under pressure. Management also needs to maintain the quality of the portfolios it manages because any deterioration in the underlying investments can impact investor confidence. Today, Nippon Life India Asset Management has a market cap of around 74,000 crore and trades at roughly 45 times earnings. Now let's move on to company number 4. During Operation Sindoor, the Indian Armed Forces used several indigenously built defense systems. One of them was supplied by this company. It was Solar Industries India. Now, most investors know it as an explosive company, but that's only half the story. Today, the company has quietly built two very different businesses. The first is its traditional explosive business, which supplies industries like mining, infra, and construction. The second one is defense. Today, Solar Industries manufactures military explosives, rocket propellants, ammunition, drones, and even the Pinaka rocket system. In other words, it's benefiting from two very long-term themes at the same time: India's infra growth and India's rising defense spending. The scale is equally impressive. Its Nagpur facility is the world's largest single location explosives manufacturing plant. The company also operates 32 manufacturing units across India and another 10 plants overseas, giving it a footprint that's very difficult to replicate. And here's something investors often overlook. This isn't a business where anyone can enter overnight. Manufacturing explosives require multiple government approvals, specialized infra, and strict safety standards. Even key raw materials are tightly regulated. So the entry barriers are extremely high. And the overall business continues to perform well. In FY26, revenue grew 30% to 9,838 crore, while profit increased 35% to 1,737 crore. But yes, of course, there are risks. This is a business that deals with explosives and ammunition. Even a single operational accident can lead to production disruptions, regulatory scrutiny, and reputational damage. So maintaining world-class safety standards isn't just important, it's critical to the business itself. Now let's look at the valuation. Solar Industries today has a market cap of around 1.63 lakh crore and trades at nearly 94 times earnings. So it's a premium valuation. Now let's move on to company number 5. Now, what do you think is the easiest way to benefit from India's aviation growth? Do you buy an airline or do you own the airports that every airline has to use? Obviously, the latter. That's where GMR Airports comes in. Today, it's India's largest private airport operator and the world's second largest airport platform. In fact, more than 1 in every 4 domestic passengers in India travels through a GMR operated airport. That's the kind of scale we are talking about. The company operates airports across Delhi, Hyderabad, Goa, and several international locations, handling nearly 134 million passengers in FY26. But here's what makes the business interesting. Management isn't just focused on increasing passenger traffic, it's focused on earning more from every passenger. Think about your last airport visit. Maybe you grabbed a coffee, bought something from duty free, paid for parking, relaxed in a lounge, or saw advertisements while waiting for your flight. Every one of these is an additional source of revenue for GMR. And these businesses are far more profitable than simply charging airline landing fees. There's another hidden opportunity too. GMR owns more than 2,500 acres of airport linked land, which can be developed over time into commercial projects. That's a long-term value driver many investors don't fully factor in. And this strategy is already reflecting in the numbers. In FY26, total income grew nearly 40% to around 15,200 crore. More importantly, the company reported a profit of 472 crore compared to a loss of 820 crore the previous year. That makes FY26 its first full year profit in more than a decade. But management believes the story is just getting started. The Bhogapuram Airport project is expected to become operational in FY27. Hyderabad Airport is awaiting new tariff approvals that could improve future earnings, and the company has also been refinancing expensive dollar debt into long-term rupee borrowings, helping reduce interest costs. Here, execution remains the biggest risk. Large airport projects take time and require significant capital. Today, GMR Airports has a market cap of around 1.14 lakh crore and trades at about 7.7 times sales. Now, let's move on to the final company on our list, Polycab India. There's an interesting debate happening around this business. Over the last year, Adani and Aditya Birla Group have both entered the wires and cables industry. Naturally, investors started asking one question: can Polycab still keep growing? Well, the numbers don't show any signs of pressure yet. In fact, FY26 was the best year in the company's history. Revenue grew 29% to nearly 28,884 crore. Profit increased 32% to around 2,708 crore. And the company ended the year with a net cash balance of around 4,200 crore. So at least for now, the new competition hasn't changed the business. But there's another reason why Polycab is interesting. Because it's no longer just a wires and cables company. Yes, that's still its biggest business, but it also sells products like fans, switches, lighting, and water heaters through its FMEG business. And it executes power transmission and electrification projects through its EPC business. Even today, wires and cables contribute around 87% of revenue, and that business grew 33% in FY26. Its FMEG business grew 25% while the EPC business had a weaker year. Now here's the next question. If Polycab is already the market leader in India, where does the next phase of growth come from? One answer is exports. Today, exports contribute only a small part of the company's revenue, which also means there's plenty of room to grow. Through its long-term strategy called Project Spring, Polycab is expanding into new international markets and strengthening its global distribution network. Back home, the opportunity already remains strong. Demand is being supported by real estate, industrial capex, renewable energy, transmission projects, and even data centers. To capture this opportunity, the company is expanding manufacturing capacity, increasing automation, strengthening backward integration, and widening its dealer network, while also investing more in premium products and its brand. But yes, of course, there are risks. Copper and aluminium prices can be volatile, which may affect demand in the short term. Export growth also depends on global conditions, and with larger players entering the industry, competition is something every investor should continue tracking. Today, Polycab has a market cap of around 1.36 lakh crore and trades at nearly 47.5 times earnings. So those were our 6 evergreen businesses, all from completely different industries, but they all have one thing in common. They are not relying on yesterday's success. They are finding new ways to grow, entering new businesses, expanding into new markets, and adapting as the world changes. And that's probably the biggest lesson from this video. An evergreen company isn't one that never faces challenges, it's one that keeps evolving. Now, I'd love to hear from you. Out of these 6 companies, which one would make it to your long-term watch list? Let us know in the comments. And if you enjoyed this video, don't forget to like, share, and subscribe. I'll see you in the next one.
Investments in securities market are subject to market risks. Read all the related documents carefully before investing.